Hi, welcome to this week's video blog at MonsterMortgage.ca. My name is Christian Harris, and today we're going to talk about posted rates. Now, if you've watched some of our previous blogs, which we hope you have, I did do a blog on posted rates where we kind of looked at banks' websites and we touched on why they still have them, and we said we'd kind of get into a blend example. So a couple months later, here we are, we're doing a blend example, because this comes up quite a bit with our clients and people who call into the show asking why banks still have posted rates. Today there's just this difference between the posted and the actual rate that a client will get. And most clients do not go into a bank and pay a posted rate when they get a mortgage. However, they're there for a reason, and one of the reasons is penalties when you go to break your mortgage, and the other one is blending. When a typical example is a client has a house, and in the middle of that term, they decide to sell that house and buy another house, and typically if they're upgrading, they need to get more money. And that's called porting, but the banks do a blend. Most institutions will blend the two dollar amounts together as well as the rate. So let me give you an example of a non-bank here, and we're going to use some simple numbers here just to keep everything simple. Let's say you have an existing $250,000 mortgage, and you're at today's 5-year rate of 3.04%. Let's say you move and you now need to double your mortgage. You need an additional $250,000. And let's assume that rates have not moved by the time you do this. So we're just going to keep everything very simple and use today's rates. So again, another 3.04%, very simple math. Your mortgage is now $500,000 and your rate stays at 3.04%. That's a non-bank blended rate. They don't have posted rates. Now let's look at the posted rate scenario with a typical bank. Let's take that $250,000. Let's even say that the rate is slightly lower. It's at 2.99% today, so that sounds a lot better than the non-bank. But let's use the same example. A couple years into your mortgage, you buy another place and you want to double that mortgage. So you're going to add another $250,000 onto your mortgage. However, today's posted rate is 5.25%. And again, back to the beginning, most clients do not pay that when they walk into a bank today. They're going to get the 304 or the 299. But this is where the banks are going to use that posted rate. They don't have to give you any type of discount because you're probably going to have a large penalty to break that mortgage. An interest rate differential penalty will be thousands of dollars, and they know this. So they can give you the new money at the $250,000 at their posted 5.25% rate. That $500,000, when you do the blend, it comes out to 4.12%. So when you look at these two scenarios, you have $500,000 at 3.04% and $500,000 at 4.12%. The difference is 1.08%, and on $500,000 at 1.08% over a new 5-year term, you're looking at $27,000, roughly. This is simple math. And again, we always say after-tax dollars. When you pay your mortgage in Canada on a principal residence, the interest is not tax deductible, so you pay after your taxes are taken off. So depending on your tax bracket, you'd have to make anywhere from $40,000 to $55,000 to actually net out 27. So that is a huge number. And again, it's not something that you may be thinking about the day you go to sign your contract. You may be looking at, oh, I've got a great rate of 2.99% versus this rate of 3.04%. But remember, banks have posted rates for a reason. It might not be for today, but it will be for down the road when they can use it against you, so to speak. So when if you're looking at buying a house today and you're looking at signing a mortgage contract, make sure you understand what's in that contract. Give us a call and we can help run through sort of a scenario to see what could happen down the road. Thank you.